Friends, it's time for an update on the Denver real estate market, and I want to look at 2026. And depending on when you're watching this, it may already be 2026. I'm recording it here in December, and I think this information will be relevant for at least a few months because a number of outlets have just dropped their 2026 predictions, and I want to look at that today. Predictions oftentimes aren't worth very much. These may not be, but at least it's a conversation point for where we might be headed with the housing market. These predictions look at the national housing market, but we could apply it to locally, what we got going on here too. And we'll talk about some local specifics in the Denver metro. If you're new here, Sam Newman, I run a real estate team here in Denver. If you would love to have a conversation tailored to your specific needs regarding real estate, please do reach out. My favorite clients are the ones who watch this YouTube channel. Don't tell the others. So where this started here was when I saw Redfin's 2026 predictions. And as a shocker to me, I thought after reading it, this is actually pretty good. Like I said, predictions may be worth something, may be worth less, but looking across a few different outlets, they're telling a similar story. And so I kind of want to give some context on that and give my thoughts about what it might mean going forward here. So this is the big headline, Redfin's 2026 predictions. Welcome to the Great Housing Reset. Well, what does that mean? That's a big, bold proclamation. And we're going to break it down. They have like 10 or 11 predictions. We're not going to go through all of them, just the main ones as far as what I think is most important. So prediction number one, mortgage rates will dip to low 6% range, one factor improving affordability. When I read that headline initially, I thought it was below 6%. And I thought that it was unrealistic for that to happen in 2026, but low 6% I think makes a lot of sense. My brain probably did that because I've seen others predicting they will be consistently in the fives mortgage rates in 2026. It doesn't seem to be likely, but Redfin is saying they're doing a very reasonable, I never know where to put myself here, tepid prediction here that the 30-year fix will average 6.3%. That I think might even be a little conservative. Average is one thing. I think by the end of the year, we could end up around 6.1. For what it's worth right now, literally today, December 11th, this 30-year fix is right at 6.3% on average. We just had a Fed meeting. Fed cut rates another 25 basis points. We don't need to get into all that, but I would expect this number to kind of wobble around where it is, and that's what Redfin is saying, and honestly maybe tick down. You see what rates have done since they jumped up. I mean, they bottomed out around 3% average, big jump in 2022, honestly later in 22, and then they peaked up near 8%, actually, just not for a sustained period of time. But since 2023, they have come down very gradually, and I'd expect that to continue. I was talking to somebody about this recently and thought that when are we going to see rates consistently in the fives? That's probably 2027, so even another year. Prediction two, home buying affordability will improve as wages grow faster than prices. And across the predictions that I'm looking at today, this is the one central theme, I think. If we're going to sum it all up, this is the central theme. So if affordability will improve for home buyers, which affordability has been a huge challenge for years. That's what's really gridlocked this housing market in a number of ways. But so affordability, they're saying, will rates come down a little bit, not a lot? Will home prices come down? Well, no. Redfin is expecting home prices to rise by 1% year over year in 2026. So a very small increase, but an increase nonetheless. Usually when we talk about affordability, we're talking about those two things. We're talking about home prices and interest rates. There is a third lever here. That is wages. That is how much money people are making. We talk a lot in the broader economy about whether or not wages are keeping up with inflation. So even if you got a raise, if it's less than the inflation rate for that year, you're not really making any more money, at least as far as things cost. Well, Redfin's prediction here is that, yes, home prices will rise a little bit, interest rates will go down a little bit, but home buying here will become more affordable because home prices will grow slower than wages, forces us to, I can do this, a sustained period for the first time since the aftermath of the financial crisis. So that would basically mean home prices are going to grow slower than wages will grow for the first time since 2009, 2010, whenever things started to level out there, probably 10, 11. But that is a big deal. The small price increase, they say, combined with mortgage rates dipping lower than they were in 25 means monthly housing payments will grow slower than wages too. So you see their graph here, basically. Purple is wage growth, red is price growth. And, finally, basically, those graphs are inverting for the first time where price growth is lower than wage growth. You do see a little dip here in 2022, but they think it's going to happen for a sustained period of time, not just a dip, which would help affordability. And that's sort of this hidden thing that we don't always talk about when we talk about home affordability. Now, the big question is, why do they think wages are going to grow faster than home prices? Yeah, Redfin can make their home price prediction, but what do they know about wages? Well, I don't know what they know about wages, and I don't know anything about what the wage market, I guess, if you will, is going to do. But just looking around with the predictions for that, CBS News says they talk about minimum wage here, and there's a number of minimum wage increases that are going to happen in 2026. 22 states and 66 cities across the U.S. are set to make a jump in minimum wage, many of them significant. In Denver, that's not going to happen. In Denver, we've already raised the minimum wage quite a bit. It's up near $19 an hour now. So that is not the biggest factor here, but this could factor into wage growth. But looking at overall wage growth, that is also predicted to go up. You see the pay scale study, and this is doing something weird for some reason, but the headline here is that employers forecast 3.5% pay increases for 2026. This is based on a study for what employers have budgeted for. So what employers are expecting to pay employees. That's what they're looking at here, and this was released in August. And so U.S.-based employers are anticipating a 3.5% average salary increase, slightly less than 3.6% for 2025. So similar number there. But basically what they're seeing, going back to Redfin's predictions and the many predictions here, is that the home prices grow 1%, and affordability, or at least interest rates, get a little bit better. And then when wages rise 3.5%, that's going to help affordability. So I'm assuming that's where they're basing that number off, some sort of study like that. When we look across the internet, we'll see more of that. 3.5% is kind of a common number for the expectation on wages to rise in 2026. Prediction 3, home sales will rise 3%. This means the number of homes sold will go up by 3%. This is just nationally looking at how many homes are being sold. You see it's been really flat and kind of bottomed out since 2023. They expect that to uptick just a little bit. They expect a stronger home buying spring season in 26 because mortgage rates are going to be a little bit better, basically 0.5% better than they were a year ago. Spring season, especially here locally, is our hottest selling season. The most homes listed, the most homes sold. Spring kind of means February to May at this point. It starts really even in January in earnest. Prediction 4, rents will rise as demand for apartments rises and supply falls. This is a national prediction, and I am not an expert on rentals, but based on what I've seen here in the Denver market, this seems unlikely to happen. Rents have fallen for multifamily units, so condos and apartments, for years now, and they just started to fall for single family units too. I don't see that changing in 2026. So if you are a renter, I think you're still going to be able to get a good deal here locally in Denver. Blah, blah. They're talking about reshaping households. I don't know. Who cares? Prediction 6, affordability crisis will unite policymakers across party lines. Good luck with that. And more Americans will refi and remodel. Yeah, we're already seeing that. The refis for people who bought at the peak of interest rates, not the peak of prices, but the peak of interest rates. We're already seeing refis happen and remodels happen because it's still easier than moving, especially when you're having to move to a different place and not necessarily get more for your money. They have some more predictions too, but just looking across the web, I wanted to see what other people were saying. Realtor.com released their forecast. As I mentioned, a lot of similarities. They think mortgage rates stay above 6%. Coming down to it here, it's easier to see in graph form. They think that mortgage rates will average 6.3%. Sounds familiar, doesn't it? I don't know if these guys are parroting each other or what, but they were released a day apart. So kind of interesting. But that is a common theme here, a slight improvement from 2025. And home prices to rise in 26. They believe home prices will rise 2.2%, so quite a bit more than the 1% that Redfin said, but they are seeing incomes grow at 3.6%, which is similar to 3.5% we saw. They have an affordability forecast. I love this because this shows payments against income over time, so percent of income spent on mortgage payments. Nationally, that was hitting at the worst of it, above 30%. They predict that to drop below 30%. This is one I like to pull up to look locally. Let me pull up my stats here from Megan Aller's report that I show so much on these market reports. Love you, Megan. Love your data. Here's our local graph of the same thing. So principal and interest payments. So basically home payments versus average income. We are just now below 40%. So nationally, affordability has been bad. It has been exacerbated locally and in certain markets. We are one of them. So it was hitting above 45% at some point. That is bad. That is really bad. And I've tried to beat that drum over and over when talking about market conditions. This is the big problem, this affordability thing, this monthly payment. We talk about home prices. We talk about interest rates. Those are factors that factor into the problem. But the real problem, the real pain point is how much money you're paying every month for your home. And so that is already improved a little here in Denver. We're looking at the red graph for that. That has come down a little bit since 2024. It really peaked the worst of it in 2023. 24 has been bad. But right now, we're just below 40%. That is still way too high. You see the historical average down here between 20. I mean, really, they talk about nationally, 20 to 25% is where you want to be. 25, even a little over 25 to 28 seems to be a healthy market when we're looking at historical data. Around 40 is way too bad. So this graph kind of illustrates what we were talking about. Mortgage rates and home prices, yes, but the third lever of those wages. And even if home prices stay the same or go up a little bit, if those wages go up more, that's going to bring this red graph down and keep gradually bringing it back to a place that's more reasonable. Back to what Realtor.com was saying, if there's anything else that interesting. No, I don't necessarily think so. They have a renter forecast, and they think that supply will continue to outpace demand, driving down rents and boosting renter mobility. That is much different from the Redfin report. I would side with Realtor.com on that one. And by the way, I wanted to show real quick, literally this morning, Compass, that's the real estate brokerage I work with, they have a very robust data department called Compass Intelligence, and they just released their 2026 housing market outlook. I won't go through the whole thing because we're getting long here, but they're singing a similar tune. And so you're seeing a lot of the same themes play out over and over. That's when predictions start to mean something to me, when there's similarities across them that everybody's kind of seeing the same thing. Doesn't mean they're right, but the signal gets louder. So 4 signals to watch in 26. Inventory, they think inventory is going to go up 10%. They think home prices will rise, but only by 0.5% nationally, so a much more conservative estimate from Compass, so not so great for sellers, but better for buyers. Mortgage rates, they say between 5.9 and 6.9, but they're going to average about 6.4, right in line with what we're seeing, 6.3 on those other predictions. And they think home sales could actually go up a little bit more, 4.25 versus 4.2, which is the other prediction we saw, 5% increase. A shift toward improving affordability. They're talking about the same thing after years of affordability challenges. We're entering a new phase of the housing market. Improved affordability, not through a dramatic price correction, okay, so not through the price lever, but through flat home prices, rising incomes, and gradually falling mortgage rates. This is the story for what overall everything we're seeing. The experts or just the people who are making these predictions expect for 2026. So this seems likely to me. I think that the problems and the challenges, like I showed in that previous graph, are exacerbated in the Denver metro. So what does this mean for you if you're a home buyer? it's still a long-term play. So good time to buy, not a good time to buy. Since I work in real estate, I'm supposed to say it's always a good time to buy. It's not always a good time to buy. Will it be in 26 is going to depend on your situation and what you want. If you're planning on being in a home for 10, 15 years, you're going to be set up well by getting into the market in 26. I believe that. Now, it depends on home type, it depends on area, it depends on a number of different things that have to be tailored to your individual situation. If you're a seller, what does this mean for you? It's not great news if you're trying to sell your home for top dollar. So you still have to do the same things you had to do in 2025, which is come up with a good, shrewd, smart plan, market the heck out of your house, make sure it's presented as well as it can be, because sellers aren't getting redos in this market, and that's going to continue in 2026. So buyers aren't able to look past things. When sellers say, they need to be able to see past it, they can't. I'm sorry, whatever it is, if it's the road, if it's the power lines, if it's the fact that your house is messy, if it's the fact that your photos are just okay and not amazing, they can't look past it. So that's not going to work. You have to show them. You can't make them imagine. Just the point being, you got to go guns blazing and do everything you can. And if you do that, and if you price your house well and position it correctly, you're still going to be fine. I've been saying recently, there's this thing that most sellers' opinion of their home value is the highest number that Zillow ever showed them on their Zestimate. Nothing against Zillow. This is not an anti-Zillow thing. Zillow is great in a lot of ways, but we know the Zestimate can be inaccurate. It can be accurate too. Maybe that was accurate. Maybe you saw 950 in 2021, for example, and now you're only seeing 850 or 860. That is, that is the current state of things. That 950 was never real unless you sold at that price. So I know it can be a bummer to see that, but you really have to work with a good team and get an accurate idea of the price for your home based on the current market conditions, not market conditions from 3 years ago, not market conditions from 6 months ago. We need to be pricing ahead of the market right now and doing a little bit of prognostication rather than looking at old data, because the data are getting stale faster and faster because this market continues to evolve. And that's what we see from these predictions. And that's what I think we'll see in 26. So like I said, if I can do anything for you, please do reach out. There should be a link below. Otherwise, love you. Talk soon.